Hi, everyone. This is Jeff Clark of thegoldadvisor.com. Welcome to the Pater Podcast. And this is your getting started video in the mining space and how to be your own venture capitalist. So, we're going to talk through some basic key steps that we think investors that are new to this sector, maybe even some veterans, need to follow to be successful. So, with me is Peter Krauth of the Silver Stock Investor. So, Peter, thanks for joining me.
Of course, Jeff. Always fun. I think we've got a lot to talk about. We've spent decades doing this and researching this, and hopefully we have a few helpful points to make today.
Yeah, that's the goal, is just to pass along a few things that we have learned that have helped us be successful, pitfalls to avoid, things like that. But the main reason we're doing this video is because the mining sector, especially the junior mining sector, is very different than other industries. And that's why you can still be your own venture capitalist, because the upside potential is enormous. And they won't all be successful, but there are things you can do. There are key steps you can take to minimize that risk and lower it so you can be more successful. This is not like buying Apple or Amazon. That's why we're going to go through some key steps. So, the first thing to be aware of is this industry has different levels, excuse me, within this space. So, you have your large producers, your senior companies, large royalty companies. These are companies that have market caps over 2 billion. The reason we're outlining this is I want you to be aware of the different levels and know exactly what you're investing in. Then you have your mid tiers, your growing producers, your developers, things like that. These are companies that usually have a $200 million market cap up to that 2 billion figure. And then you have your juniors, where a lot of us like to play. That is the highest potential, but it's also the highest risk. And these are typically exploration companies that are looking for gold or other metals, have not really found any yet. Their market caps are from under 10 million up to about 200 million. You want to be aware of what you're investing in, because the risk level increases as you go down that ladder. Your potential increases, though, as you also go down that ladder. So there's several other key steps. Peter, you're going to share some of those with us.
Absolutely. So, if this is something, a space that you want to be involved in, it's of course important, and I think more than ever, I certainly feel that we are in for what I call an inflation decade. We've seen the last few years have been very inflationary, up to 9% a couple of years ago. That has dialed back. I do believe that is going to come roaring back, probably, possibly within as little as another year. We could start to see inflation start to tick up once again. But what we know is that resources do well in this kind of an environment. They're tangible, and because they're priced in US dollars, and this is, a known fact around the world, and dollars are appreciating. We've seen this happen, for forever, and faster and faster. They depreciate faster and faster. The higher inflation is, the more you want exposure to resources. They absolutely protect in that kind of environment. That's what happened in the 1970s. We saw lots of inflation. And that's when we saw oil, gold, and silver do really, really well. And so we emphasize gold and silver here. These tend to do especially well in most business and inflationary cycles. In the 1970s, gold was up 1,400% in that decade. Silver was up 3,700%. So really what you need to do as an investor is decide the portion of your portfolio that you want to allocate to resource investments. That could be 10, could be 20, 30%, whatever you feel comfortable with. And then you need to decide which sectors you want exposure to. And that's what Jeff was talking about earlier. You have the larger companies, the larger caps. These tend to be producers. You could even have some of the big royalty companies in there. And then as you move down that ladder, you've got the developers and the explorers. And you don't have to have exposure to all of them. You need to know yourself as an investor, what your risk level is, your comfort with risk. And then you can combine these. You can have exposure to all of these sectors, just some of them. You can have your portfolio weighted more to the lower risk area. You could have a little bit more weight to the higher risk area. It all depends on your own comfort. But these are ideas of how you can build exposure to a portfolio that has uh, all of these types of companies in them, from, as I say, the larger to the smaller caps. And again, though, the key thought here is that commodities will provide you protection in an inflationary environment. And these are the kinds of things that we talk about. And silver and gold in particular provide protection in nearly all business cycles. So if, or likely when, we go into some kind of a recession, these are the kinds of metals that will probably protect you better than any. So Jeff, I think that you could probably tell us a little bit about the kinds of things people may want to look for in terms of a stock or a company. What are the features that make the most sense for a quality pick?
Here's what I look for in a mining stock, and what I encourage you to start looking at is the three legs of the stool. And people call it different things, but that basically means the people behind the project or with the company, the politics, the region where this asset is located, and then the project itself. And I do mean in that order. You want to start with the people, and the book Pater goes into this in a lot more detail. But basically, with people, you want to look for two things. You want to look for someone who not just has experience or someone you like when you meet them or makes a good pitch or has a good story. You want to look at the companies that they've ran before during their tenure and look at the stock price and what it did. And that'll tell you immediately if this is someone who knows how to create shareholder value. I do that all the time. I encourage you to do it as well for any leadership of a company you're looking at. The second thing is I want to know that they are at risk financially. I want to know that they've put a lot of money of their own money into this to the point where they must make this venture succeed. It doesn't guarantee success, but it tells you that they will work as hard as they can to make it a success. So I look at those two things when I start with the people. The second thing is the politics, meaning the jurisdiction or the country where this asset is located. You want obviously a pro-mining jurisdiction, and keep in mind you can't move the asset, you can't move the mine. So you need a country or a jurisdiction that has a long rule of law, that they have strong property rights, and they've done this historically within their country. That's what you're looking for. So stick to pro-mining jurisdictions that will immediately reduce your risk. And then finally, I look at the property or the project itself, and that is, what this project has going for it, what the potential is. If you're looking at explorers and juniors, the two things you want to look for are just like my grandma's chocolate chip cookies. You want something big and rich, and that's what you're looking for. And you won't know that with explorers in the beginning, but as you monitor them and you watch them, you want to see, okay, can this asset become big and rich? That's what you're looking for. So you always want to start with those things. Again, there's more detail in both of our books for Peter and I, but start there, and that'll immediately reduce your risk and give you the best chance for succeeding. Peter, what else you got for us?
So I guess sort of the one last area I want to cover is a little bit about how you may want to invest. What is the right time to buy, and ultimately, what is the right time to sell? So again, I said it before, I believe we are at the start of an inflationary cycle. I think it could last as long as a decade. We may only be a few years into it, and commodities do well in that kind of environment. So I certainly believe, and some of the smartest analysts and institutional investors even believe that we are at the start of a long-term secular commodity bull market. So we can have a long ride ahead of us. What you want, and I'm going to say ideally, is for the commodity to be selling near or even perhaps below its cost to produce. That means that you're buying at an opportune time because the companies that are there are amongst the few that are managing to be able to turn a profit. If in some cases, perhaps not, but things may be quite tight. But it's hard for things to, at that point, to get cheaper, and the risk is really low. And sentiment can also be at that point very low. So that's not an easy thing to do. You kind of really want to be contrarian. So, but the contrarians, people with patience, are the ones who tend to do the best longer term. So, as I say, patience is key. You certainly want to arm yourself with that. You want to buy when the commodity price starts to trend up. We've certainly seen that already in the last couple of years. I think what happened with COVID, I think it really kind of kicked in prior to COVID, but when COVID came along, and governments worldwide in a coordinated way started to print money and stimulate, that really kicked off this new commodities bull. I think we're still very much in the early days of that. We've started to see the commodity prices start to trend up. And we've only really started to see the companies that produce these things see their share prices start to trend up. And that's because those higher commodity prices have started to filter down to their bottom lines. And we've seen some of the smart money start to move into this, and some of the big fund managers have started to buy these deep value companies. So that's the start of the cycle. It moves up generally, in a from bottom left to top right is the way a beautiful chart will move. You'll have these cycles along the way, but nonetheless, I think we're still early days. Ultimately, you get to a point where sentiment is very high. Now, we are certainly not at that point. That's a long way off. And again, you have these smaller cycles in between, but ultimately, when you get to where sentiment is very high, mainstream media is talking about commodities, all day long. You're seeing this on BNN, CNN, Bloomberg, everywhere. And that's the time when you're going to really start to ask yourself if your portfolio is way more than fairly valued. It's becomes well overvalued, and you're going to want to look at some investments or portions of investments throughout that bull market. You're going to want to hang on to. At some points, you will want to take profits as we work through these mid-secular cycles. But as I say, some you will want to hang on for the entire bull run. Some, as their valuations get really rich, you're going to want to take some profits. That's the kind of thing that Jeff and I talk about in our paid newsletters. Jeff's letter is Paid Prospector, mine is Silver Stock Investor. And so these are ways to follow these markets in a real-time fashion. We talk about what we do in many ways, in many cases, almost on a daily basis. So you get to follow what we do almost in real time. Um, I talk about silver in particular. My book, The Great Silver Bull, is all about really the general opportunity in silver and how I see this as a generational bull market and a generational opportunity. But as I say, the newsletter, Silver Stock Investor, for me, Paid Prospector for Jeff, is a real-time way to follow what is happening in these markets. And a couple of months back, I launched another newsletter called Silver Premium. That's really just focused on financing opportunities in the silver space. That's really meant for accredited investors. If that's the kind of thing that you feel you're comfortable with, you can look into that a little bit more. But I think we've given you a good overview of how you can get started in this space, how you can allocate, what kinds of things to look for, and really following our work on a closer basis will help you probably, I think, get more comfortable with the kinds of steps that you can or you may want to take. You can follow what we do, and I think just sort of following what we're talking about more regularly will help you get more comfortable and perhaps take some of those first steps. So hopefully we've given you a good basic intro to how you can get started investing in this space and really perhaps become your own venture capitalist. The opportunities really are there. It's an exciting space to be involved in, and think that kind of wraps it up for me, Jeff. Maybe you want to throw in a few final words.
You can be your own venture capitalist in this industry. You really can because the kind of returns that typically are grabbed by hedge funds and institutional investors are available to us if you want to do your own stock picking. We do have some free resources for you at thegoldadvisor.com. You can check them out. And the Gold Advisor portfolio actually follows anywhere from 20 to 25 mining stocks that we personally own. This is an over-the-shoulder look, and we provide newsletter quality analysis on all those companies to help you with education, even if you don't buy the stock, just to help you learn more about the industry and more about companies and what they're doing, how to interpret things and what they mean. That's what we're trying to do with the free sites. And then we have, like Peter mentioned, the pay letter. My pay letter is Peter Prospector. That's where I'm going a little bit further down the ladder, looking at those explorers and juniors, some developers that have a higher potential. They will not all be successful, but once you get a taste of a five bagger or a 10 bagger, sometimes even more, that can not only make up for a few losses you might have, but really put you in the green. And that's what we're trying to do with that paid letter. It's not that expensive, neither is Peter's. So we hope you check that out if you want to speculate a little bit more. And again, we both have our books on the site. You can see that on the tab. But most of all, we want you to see what we're doing to the extent that you want to learn about the industry, to educate yourself so that you can be your own successful venture capitalist. Thanks for watching here at the Pater Podcast. We hope you find this video useful. Peter, thanks for joining me, and we'll see you all later on the website.